Hey guys, welcome to Cris Bell As Is. Today we're continuing our series on the 2021 housing outlook, and today we're going to talk about the Federal Reserve, M2 money supply, and just some of the things you should be thinking about as we go into and through 2021, and what some of that means to the housing market. So one of the things that's important here is when you're looking at the Federal Reserve is, if you don't know, is to understand that they are not a part of the government. They are a private held entity that essentially controls the money supply in the United States, and the United States is the currency that basically is used around the world. And one of the things that we've seen is since our fiat currency was taken off the gold standard in the early 70s, our dollar has devalued, continually devalued over time. And some of that you can see from inflation. And so what we want to get into here is recent statements. This is end of January 2021. Federal Reserve released a statement talking about what they were intending to do. And they intend to, you guys can see here, basically to increase inflation moderately over time. We've historically been low inflation, so we can look here at another chart and just see that our inflation 2019 was essentially, so this is the CPI index, is 2%, 1.8%. It's been pretty low, all the way back to, I don't know, say here, all the way back to 1992, and even as far back, I guess is 1985, relatively low inflation. So what the Fed is saying here is that they plan for higher inflation, and they're going to look to control that. And they're also saying that they're looking to keep the federal funds rate low. So you can see that here in what they posted. Something to keep in mind is that the Fed funds rate is, when that goes up or down, that doesn't necessarily have a bearing on 30-year mortgage rates. 30-year mortgage rates are typically more closely aligned to the 10-year treasury yields. So let's see, I think I had a graph up here for 10-year treasury yields. Maybe I didn't. So anyway, the M2 money supply here is, the reason that this is important is because M2 money, there's M1 money, M2 money, and they all basically allude to how much money supply is in the market to be spent. And what we can see here is there's a relationship to the amount of money supplied in a market versus the inflation. So what you can see here is inflation is in red. So high inflation typically means you're going to have higher amounts of interest rates. So if we go back and we look in the 70s, when there was basically some hyperinflation, what you can see is when the inflation is super high, the money supply is low. But if you look just before that, the money supply was really high, and then inflation came in. So we're in a similar scenario now. I did mention that the 10-year treasury yields are basically in alignment with what happens with the 30-year fixed mortgages. So it's not tied to the Federal Reserve fund rates. Federal Reserve fund rates is essentially the rate that banks lend to each other. So just a chart here so you guys can see basically, whoops, let's see, I want to go to this one here. So this is 30-year fixed mortgage rates, 10-year treasury yield. You can see that the treasury yields in red and 30-year fixed mortgages typically are, 1.5, 2 basis points or 2% higher than what the treasury yield is. One of the things that we saw in midsummer of 2020, so around June, July timeframe, the 10-year treasury yield was super low. It was probably the lowest point it had been in quite some time, but it was at essentially 0.5%. So that's where you started to see the 2%, 2.5%, 2.8% 30-year mortgages coming in. And as of the time of this recording, so we are in March of 2021, the 10-year treasury yield is floating at about 1.5, 1.6. So you're probably seeing 30-year mortgages move back into the 3.25 range, 3.5 range. So that's important to know because that's tied to what's happening in the housing market. Something else to just be aware of, and we talked about this a little in the last video, was M2 money supply. What we can see over here is with all the stimulus checks and all the printing of money that the government has done with the CARE Acts, they have literally pushed trillions of dollars into the U.S. economy. So you can see here, I mean, this is the history of money supply here for the United States. We've got more money in the market basically than any time in history. So you can just kind of go back and look over this, and every time that we've had more money in the market than, say, normal, whatever normal may be, it's been met with an inflation run up shortly thereafter. So as you can see, basically since 1980, inflation is gone up and down, but the trend line is inflation has gone down. So even when you see some spikes here in money, M2 money supply, you can see shortly thereafter there was an increase in inflation. So inflation did go up. So now we're just seeing, that we've got more money supply than ever before. Leads you to believe that you're going to see high inflation. So inflation makes prices of commodities rise. So that's natural resources, food. You'll start to see all of that rise, in a given time frame here. Typically, you're looking at, so this is 76 to a spike in inflation at 80. So in 4 years, they went from high money supply to a spike. So also wanted to share some good information with you guys, some good videos on YouTube. So this is one from George Gammon, just really detailing what's going on with the Fed and how that works. And here's another one from Peter Schiff on how to think about the Federal Reserve. I'll put links to those in the videos. But all of this is pointing to the direction of higher interest rates and inflation coming. Take care.